There's a trap so perfect, so invisible, that even America's enemies pay rent to live inside it. Right now, in 2026, every major economy on Earth is trying to escape dollar dependence. China's building alternative payment systems, Russia's trading in rubles. The BRICS nations signed agreements to bypass the dollar entirely. Saudi Arabia, America's oldest Middle Eastern ally, just accepted yuan for oil. The headlines scream the same message: the dollar is dying, American dominance is ending, the empire is collapsing. But here's what the data actually shows. Despite 15 years of de-dollarization efforts, despite sanctions wars and trade conflicts, despite every country claiming they're done with America, the dollar's share of global reserves has barely moved. 58% of all central bank reserves still held in dollars. 88% of all foreign exchange transactions still involve the dollar. And when there's a crisis, when markets panic, when uncertainty hits, capital doesn't flee America. It floods into it. Every single time. This isn't American exceptionalism. This isn't propaganda. This is the mathematics of a system so deeply embedded in global infrastructure that escaping it means destroying the machine that keeps your own economy running. If you want to understand why the world can't quit the USA, even when they desperately want to, if you're ready to see the cage everyone's trapped inside, hit subscribe to Fin Historian, because we're about to show you the 7 locks on the door. And every time a country thinks they've picked one, they discover 6 more they didn't know existed. Let's start with 1944. World War II is ending. Europe is rubble. Asia is devastated. And 730 delegates from 44 countries gather at a hotel in Bretton Woods, New Hampshire. They're designing the post-war financial system. The question on the table is simple. What becomes the world's reserve currency? Britain wants the pound. They've been the global reserve for 200 years, but Britain is bankrupt. They owe America billions. Their empire is crumbling. They have no leverage. America offers a deal. Make the dollar the global reserve currency. Peg it to gold at $35 per ounce. Peg every other currency to the dollar. And America will use the Marshall Plan to rebuild Europe and Japan. Basically, we'll lend you the money to buy from us, and you'll trade in our currency to do it. The world accepted. Not because they loved America, because they had no choice. The US had 60% of global gold reserves. The US had the only major economy that hadn't been bombed into dust. The US had the military that won the war. The Bretton Woods system created the foundation. But here's what people miss about why it worked. The dollar wasn't just backed by gold. It was backed by something more valuable: access to the American market. After 1944, if you wanted to sell your goods to American consumers, you needed dollars. If you wanted American investment in your factories, you needed dollars. If you wanted protection from the Soviet Union, you accepted dollars. The currency became the key to prosperity. And here's the trap that was set in 1944 that still holds today. Once the world's trade contracts, debt instruments, and savings were denominated in dollars, switching became catastrophically expensive. Let me show you the mechanics. Lock number 1. The debt denominated in dollars. Imagine you're Argentina in 1980. You want to build infrastructure. Roads, power plants, ports. You borrow $50 billion from international banks. But here's the key detail. The loan is denominated in dollars, not pesos. Why does this matter? Because now you have to earn dollars to repay it. You have to export goods to America or Europe, collect dollars, and service your debt. If you try to de-dollarize, if you refuse to trade in dollars anymore, you can't pay your loans. You default. Your economy collapses. This is the first lock. As of 2026, developing nations owe over $13 trillion in dollar-denominated debt. China holds $3 trillion in dollar reserves. Japan holds $1.1 trillion. These aren't small amounts. These are the foundations of their financial systems. If the dollar suddenly disappeared, if it became worthless tomorrow, that $13 trillion in debt doesn't disappear. it becomes unpayable. Every country with dollar debt would default simultaneously. The global banking system would collapse. So when China says they want to de-dollarize, they're facing a math problem. They hold $3 trillion in dollar assets. To dump those assets, they'd have to sell them. But who's buying? If everyone's trying to escape dollars at the same time, there's no buyer. The price crashes. China takes a $2 trillion loss on their own reserves. That's the lock. The world is so deep in dollar debt that escape means bankruptcy. Lock number 2, the petrodollar system. In 1973, America faced a crisis. Nixon had closed the gold window in 1971. The dollar was no longer backed by gold. It was pure fiat currency. And OPEC, the oil cartel, just quadrupled oil prices. The Arab oil embargo was crushing the U.S. economy. Henry Kissinger, Nixon's Secretary of State, flew to Saudi Arabia with a deal. We'll sell you weapons. We'll guarantee your security. We'll protect you from Israel, from Iran, from anyone who threatens you. In exchange, you do one thing. You price oil in dollars. You only accept dollars for oil, and you reinvest those dollars in U.S. Treasury bonds. Saudi Arabia agreed. Then Kissinger cut the same deal with Kuwait, with UAE, with every major oil producer. By 1975, the petrodollar system was locked in. Here's why this mattered. Every country on Earth needs oil. Factories need it. Trucks need it. Power plants need it. Plastics, chemicals, transportation, all oil dependent. And if oil is only sold in dollars, every country needs to hold dollars. This created artificial demand. Even if you're Japan and you hate relying on America, you still need dollars because you need to buy oil from Saudi Arabia. Even if you're Germany and you want to trade in euros, you still stockpile dollars because oil is the one commodity you cannot do without. The petrodollar locked the world into dollar dependency through energy, and for 50 years it held perfectly. But here's where it gets interesting. In 2023, Saudi Arabia signed agreements to accept yuan for Chinese oil purchases. In 2024, Russia and India started trading oil in rubles and rupees. The petrodollar is cracking. So why hasn't the dollar collapsed? Because even with oil accepting other currencies, there's lock number 3, the liquidity trap. Let me explain liquidity. It's not about how much of a currency exists. It's about how easily you can trade it without moving the price. The dollar is the most liquid currency on Earth. There's $6.8 trillion in daily foreign exchange trading. 88% of those trades involve the dollar. If you want to convert yen to euros, you don't trade yen for euros directly. You trade yen for dollars, then dollars for euros. The dollar is the bridge currency for everything. This creates massive liquidity. If you're a pension fund in Norway and you need to sell $500 million in assets today, you can do it in dollars without moving the market. Try that in yuan. Try that in rubles. The market's too small. You sell $500 million worth of yuan and the price crashes 10%. You just lost $50 million on the transaction. This is why central banks hold dollars even when they don't want to. It's not about trust, it's about liquidity. The dollar is the only currency you can move in massive size, instantly, without destroying the price. And here's the trap within the trap. The more people use dollars because of liquidity, the more liquid the dollar becomes. It's a self-reinforcing loop. The dollar dominates because it's liquid, and it's liquid because it dominates. China's tried to break this. They've built the cross-border interbank payment system, CIPS, to rival SWIFT. They've signed currency swap agreements with 40 countries. And as of 2024, the yuan represents 2.8% of global payments. Not 28%, 2.8. After 15 years of de-dollarization efforts, after China becoming the world's largest trading nation, they've captured less than 3% of the global payment system. Why? Because liquidity is a network effect, and the dollar has a 70-year head start. Lock number 4, the Treasury market as collateral. This one's technical, but it's the most important. After the 2008 financial crisis, global regulators passed Basel III. It's a set of banking rules that force every major bank in the world to hold high-quality liquid assets, safe stuff that won't lose value in a crisis. What qualifies as high-quality liquid assets? U.S. Treasury bonds, German bunds, UK gilts, Japanese government bonds. But here's the problem. The German bond market is 2.5 trillion. Japan's is 10 trillion. The U.S. Treasury market is 27 trillion. If you're a bank in Singapore and you need to hold $100 billion in safe assets, where do you put it? There's only one market big enough: U.S. Treasuries. This creates structural demand that has nothing to do with trust or politics. Banks are legally required to hold treasuries. Insurance companies are required to hold them. Pension funds are required to hold them. It's baked into global financial regulations. And here's the dark brilliance. The more the U.S. borrows, the more treasuries exist, the more collateral is available for the global banking system. If the U.S. actually paid off its debt, if it stopped borrowing, there wouldn't be enough safe assets in the world. Banks couldn't meet their capital requirements. The system would seize. The world needs the U.S. to be in debt. The global financial system is built on it. Lock number 5. SWIFT and the payment rails. SWIFT, Society for Worldwide Interbank Financial Telecommunication. It's the messaging system that banks use to transfer money internationally. If you're in Brazil and you want to pay a supplier in Vietnam, your bank sends a SWIFT message to their bank. The money moves. SWIFT processes 45 million messages per day. Over 11,000 financial institutions in 200 countries use it. And while SWIFT is technically based in Belgium, neutral territory, it operates under Western law. The US and EU can cut countries off. In 2012, SWIFT disconnected Iranian banks. Iran's economy collapsed within months. They couldn't receive payments for oil. They couldn't pay for imports. The currency crashed, 50%. In 2022, after Russia invaded Ukraine, SWIFT cut off Russian banks. Not all of them, but enough to cripple trade. Russia's oil revenue dropped 30% overnight. This showed the world something terrifying. The payment system itself is a weapon. Even if you trade in yuan or rubles, if the transaction runs through SWIFT, the West can shut it down. China's building alternatives, CIPS for yuan. Russia built SPFS. But here's the problem. Those systems only work inside their own networks. If you're a Brazilian company buying Chinese goods, you can use CIPS. But if you need to pay a European supplier next week, you're back to SWIFT, back to dollars. The infrastructure lock is brutal. You can create alternative currencies, but if the payment rails only connect to the dollar system, you're still trapped. Lock number 6, the military enforcement. Let's talk about something nobody wants to admit. The global economy runs on a very simple assumption. Ships full of goods can cross oceans without getting sunk or stolen. For most of human history, that assumption was false. The oceans were a war zone. Pirates, privateers, and rival navies attacked merchant ships constantly. If you wanted your cargo to arrive safely, you needed your own warships to protect it. Then came 1945. The US made a deal with the world. You trade in dollars, you align with us against the Soviets, and we'll protect your shipping. We'll patrol the oceans. We'll keep the sea lanes open. You don't need a navy. We'll do it. This was the most generous bribe in history, and it worked. Global trade exploded. Germany could sell cars to Japan without a German destroyer escorting the ship. China could import oil from the Middle East without a Chinese carrier group in the Persian Gulf. The U.S. Navy became the guarantor of global commerce. 11 carrier battle groups, 60 destroyers, submarines and aircraft patrolling every major shipping lane. The oceans became safe for the first time in human history. But here's the enforcement mechanism. That safety isn't free. The U.S. spends $230 billion per year on the Navy, and the implicit deal is simple. Play by our rules, trade in our currency, and we'll protect your trade. Refuse, and you're on your own. Look at what happened in 2024. Houthi rebels in Yemen started attacking ships in the Red Sea. Insurance rates for shipping spiked 300%. Global supply chains rerouted around Africa, adding 2 weeks to every voyage. Who fixed it? The U.S. Navy. Operation Prosperity Guardian. Now imagine the U.S. goes full isolationist. Imagine we pull the Navy home. The Strait of Hormuz, 20% of the world's oil passes through it. Iran could close it tomorrow. The Strait of Malacca, 80% of China's energy imports. If pirates or hostile nations shut it down, China goes dark within weeks. The military lock is the physical enforcement layer. The dollar is backed by the most powerful navy in history, and that navy can turn off global trade with a blockade. Lock number 7, the brain drain and network effects. This is the invisible lock, the one nobody talks about. Even if a country wants to de-dollarize, even if they have the resources and the plan, they face a final problem. Their best people don't want to. Where do the smartest minds in China want to work? NVIDIA, Google, OpenAI, American companies. Why? Because that's where the frontier research happens. That's where the money is. That's where the opportunities are. The U.S. doesn't just control currency and military power. It controls human capital. The global elite send their children to Harvard, MIT, Stanford. They learn in English. They network with Americans. They absorb American culture and business practices. And when they go home, they bring that back. China's tech industry is built by people educated in America. India's startup ecosystem is run by people who worked in Silicon Valley. Even the people trying to build alternatives to the dollar were trained in the dollar system. This creates a cultural lock. The language of global business is English. The concepts of finance, innovation, and entrepreneurship are American exports. You can build a Chinese payment system, but the people designing it are thinking in frameworks they learned at Wharton. The network effect is complete. The dollar isn't just a currency, it's the operating system of global commerce, and everyone is running apps built for that OS. So let's put it together. 7 locks. Dollar-denominated debt. Petrodollar system. Liquidity dominance. Treasury collateral requirements. Swift payment infrastructure. Military enforcement of trade routes. Cultural and intellectual network effects. Every country trying to escape faces all 7 simultaneously. You can pick 1 or 2 locks. China's working on CIPS. Russia's trading oil in rubles. But you can't pick all 7 at once without blowing up your own economy. And here's the final trap. The weaker your economy gets, the harder it becomes to escape. If China's economy slows, capital flees to safety. Where's safety? U.S. Treasuries, dollar assets. The weaker China gets, the more dollars they need. If Europe stagnates, investors pull out. Where do they go? New York, the S&P 500. The weaker Europe gets, the more capital flows to America. This is the dollar trap in its purest form. The system is designed so that trying to leave makes you weaker, and being weaker makes you more dependent. It's a black hole. The closer you get to escape, the stronger the gravitational pull becomes. In 2025, we're watching this play out in real time. BRICS nations announce de-dollarization plans. Markets panic. Their currencies crash. They run back to dollar swap lines to stabilize. The trap closes tighter. So can anyone escape? Is it even possible? The honest answer is maybe, but not the way people think. The only way out is to build a parallel system so large, so liquid, so trusted that it rivals the dollar. That means 50 years of consistent policy. It means letting your currency float freely. It means opening your capital markets completely. It means no capital controls, no government manipulation, and letting global investors hold your bonds without fear of seizure. China can't do that. The Communist Party won't give up control. Russia can't do that. They're sanctioned into isolation. Europe could do that, theoretically, but they can't agree on fiscal policy long enough to build it. The only entity that could replace the dollar is another version of America, a massive, open, liquid market with military power to back it and institutions stable enough to trust. And that doesn't exist. So here's where we are. The world knows the dollar is a trap. They know it gives America disproportionate power. They know it's unfair. And they're absolutely right. But the trap is so well built, so deeply embedded in global infrastructure, that escape means economic suicide. You can complain. You can build alternatives around the edges. But the core system, the dollar as the reserve currency, the Treasury as the global safe asset, the U.S. Navy as the guarantor of trade, that's locked in. Not because America is morally superior, not because the dollar is the best currency, but because the network effects and infrastructure dependencies are too massive to unwind. The world can't quit the USA, not because they don't want to, because the cost of leaving is higher than the cost of staying. That's the dollar trap. And it's not breaking anytime soon. If this showed you how the cage was built, if you finally understand why de-dollarization keeps failing despite 15 years of headlines, then you need to subscribe to FinHistorian. Because next week, we're showing you what happens when a trapped system starts to crack. The mechanics of currency collapse. The moment when empires realize the trap has become a prison, and why the US might be the one to break its own system. Hit subscribe. History doesn't repeat, but the patterns are absolute, and I'll show you where to look.